Welcome back to Fresh Outlook, everybody. I'm Logan Crawford, your host. Since Lehman Brothers went bankrupt back in September of 2008, the world's central banks have injected more than $12 trillion under quantitative easing programs into financial markets. More than 26 trillion with the T dollars of government bonds are now trading at yields of below 1%. These policies, according to the policymakers, have been crucial to the recovery. Others, however, are scared that we've been inflating yet another bubble. Let's say hello to our expert panel here at Fresh Outlook. I am joined by Charles Steindl, scholar at Ramapo University, former executive as well at the Federal Reserve Bank. Jim McCarthy, certified financial planner from Directional Wealth Management. Uhura Williams joining us once again for this segment. And joining us live via our connection in DC is Jim Pierce, Director of Portfolio Strategy for Investing Daily. Jim Pierce, you're up in the monitor, so I will begin with you. Quantitative easing, that's printing money, right? That's got to be bad. What say you, sir?
Well, it's got to be bad, but sometimes the alternative is worse. Big question is kind of where did all that money end up and how's it going to work its way through the system? If you look at what assets appreciated over the previous 5 years, obviously the stock market was one of the biggest beneficiaries. The U.S. real estate market also benefited. However, we don't see any appreciation or much in commodities. In fact, we've seen some depreciation. So it has distorted the global economy to some degree. The question is how much and how's it going to play out over the next 3, 4, 5 years.
Okay, let's turn to Charles Steindl. Charles, are we creating a huge bubble that is going to actually dwarf what happened in the housing bubble scandal?
I don't think there's any real signs of it. I mean, the stock markets are around the world, in the U.S. especially, are a bit elevated. A few other markets are a little bit elevated, but there's nothing like some mad frenzy of going around and buy this now. There certainly isn't any bubble atmosphere out here. A few markets, a few scattered signs, but nothing much.
Will there be a dramatic impact if and when the Fed raises interest rates?
No, because this is the most telegraphed move that ever was. 2 p.m. on December 16th, rates will go up. The market would have built it in. There might be a little reaction to exactly what the Fed says in the statement, about which they want to get a hint of when the next rate increase will be. But this rate increase is over and done with as far as the markets are concerned.
Okay, let's turn to Jim McCarthy. Jim, for the folks at home, and they're concerned about their 401ks and the price of their home and all of the normal investments that people have, what's the takeaway for them?
Well, I think, as the one gentleman said, obviously 401ks, the stock market has done reasonably well, specifically here in the U.S. On the other side of the coin, right now, if you've had money in fixed income and bonds, you've done fairly well over the last few years. Now, if you have your bonds that are maturing or you've got a CD that's coming due, it's a little bit harder because rates, as you pointed out, are so low. So how do you reinvest that and get income from a more conservative investment than the stock market? So I think in some cases, rates starting to slowly increase will prove to be a benefit, certainly to clients who are in retirement or getting ready to retire and are looking for safe investments that provide enough income to live on.
Uhura, what do you see as the headline in all this as you look into 2016? Do you think we've created another bubble?
Not necessarily. I mean, I have to agree that I think if we're looking at this in the context of job growth, the fact that you have a decrease in unemployment, I do agree that this is the most telegraphed move ever, that we know that that's going to happen on the 16th. There'll be some reaction, but I don't think it'll be severe. I think most people will respond accordingly. I mean, we look at this in the context of, again, what will happen in the average household. And there's no reason for anyone to be concerned at this point that you would have a reaction in the sense that would force us into another bubble.
All right, let's turn to Jim Pierce for just a second. Jim, if you peer into that crystal ball in front of you, what do you see for 2016? What is your forecast?
And I'm sorry, I have a little trouble with the earpiece here. 2016, I think we're looking at the reversal of really a 35-year decline in interest rates and bonds. So I think that's the big story, not just for 2016, but maybe for the next couple of decades, because that will change the interrelationship between bonds and stocks and commodities and currencies and everything else. So 2016 will be the beginning of that story, but that'll take a long time to play out. Getting back to the point I made a moment ago, I wouldn't be surprised to see commodity prices start to tick up in 2016. There's no signs of rampant inflation really anywhere in the world, but I think those prices have been driven a little bit artificially low. So we'll see kind of a reversal in trend between bond prices and commodity prices. I think that'll be the first sign of it in 2016.
Thank you, Jim. Charles, it comes up every now and then as a political issue, and that is the deficit. If you listen to the pundits, they say that Barack Obama is the biggest deficit spending president in the history of U.S. presidents. Is that an issue? Is that a problem? Is it something the average American really needs to be worried about, or are sky-high deficits okay?
Well, first of all, the deficits aren't so sky-high. The deficit in the last fiscal year was about $430 billion, which was less than half of what it was 5 or 6 years ago. As a share of GDP, it's not that big. The real deficit problem, as people have been saying for years, is not what's going on now. There'll be improvement the next couple of years. It's going down 5-10 years in the future when the bills for Social Security ramp up and the bills for Medicare really start to move up. That's the issue.
Let me just ask you this, and Bernie Sanders has posed it very eloquently. Why not just lift the cap on Social Security contributions, remove that artificial $118,000 cap, and make Social Security solvent again? It seems like an easy fix. Let the very rich pay as much as somebody who makes $118,000 a year.
Well, financially, it's a fix. But the question is, it changes the philosophy of the program, which has continued for 80 years. For 80 years, the philosophy is the program. What you get out depends on your salary and what you put in. That would break it at the top. Now, that's really not an economics issue. That's a political issue, entirely a political issue, how you might want to handle it. But I would want to add, Social Security is a relatively straightforward problem to solve. Medicare and Medicaid, the health care is still the big issue, and we still have to see. We've seen much slower growth in medical care costs the last few years. Whether it's Obamacare bringing down costs, we don't know, but we have to see how that plays out.
Okay. Jim, let's say I'm a cop, my wife is a nurse, we're trying to plan for our children's future, one's 6, one's 8. What do you suggest to them? Mutual funds? I mean, we talk about the bond market. If you're a guy like me, you glaze over when you hear about it. You're not even sure exactly what it means. I've never bought a bond in my whole life, other than a U.S. savings bond,
there you go,
which I cashed in before they matured. Damn me.
They had good rates, actually.
So what is your advice to the average
I think,
couple like that?
You know, for me, as a financial planner, the first thing is you have to have a plan. You have to have a roadmap for what you're trying to accomplish. So that's really understanding what your goals are for the future and where you are today, and then mapping a course on how to get there. It involves both managing your savings and your spending, obviously. Trying to keep yourself in very good, if you have to have debt, make it good debt, like a home equity or a home loan is a good debt versus a car loan or a credit card is bad debt. So keep your debt low, keep your savings high. Some people, if you're a police officer, you're probably lucky enough to have a pension. You're a government service type person. That puts you sort of in a pretty good spot.
And an elite category nowadays,
exactly,
too.
Very good. Elite's a great word for it. Whereas a nurse is probably somebody that's going to have to survive on saving through a 401k and the like. I will say that one of the things that's happened with the low interest rates, both for individual families and for businesses in the U.S., is they've been able to fix their balance sheets. When we hit the problem in 2008, the housing bubble, it was because a lot of individual people were over-levered. They either had used home equity on their homes as a piggy bank, so they owed more, and when the prices of the houses fell, now all of a sudden they owed more on their home than they did before. A lot of people have refinanced with these low rates. Not only individuals, but businesses have around the U.S. So I think that's why I agree that we're not really going to see too big of a bubble. The big burden of debt has been shifted to the government shoulders off of the individual shoulders, which is where it was in 2008. So I think that that's a positive for the fact that we won't have a bubble going forward.
Euro, as you look at this political circus of 2015 going to 2016, are there any standout economic plans that you've heard other than Donald Trump's, who I know you work on his campaign?
What you hear are politicians rehashing the kind of standard talking points that we associate with in the election because they're really afraid to go out on a limb and to state claim in a way that they'll be held accountable later on. So what we're getting is typical political speak that you expect in the election cycle from everybody on both the left and the right. Pretty predictable.
Charles Steindl, do you have as you look at the field of the 40 or 5 candidates who are running for president, is there a standout economic plan that you see?
No, I wouldn't. There might be some standouts on the low side that I've seen, but I don't want to get into that. I wouldn't say that there is anybody who stands out, but I think I agree that there tend to be just rehashing of partisan, traditional partisan views.
Is Bernie Sanders' plan completely unsustainable? Does it make zero economic sense, as some critics have charged?
I don't think so. Not necessarily. I mean, it's a progressive plan. I mean, it's no more ludicrous than people who talk about cutting taxes will generate economic growth. I mean, it's a question of how much and when.
So what about cutting taxes, like Ben Carson says, to 10% tithe instead of paying taxes?
Well, obviously there's been some dispute of what exactly he meant by the tithing comment and what the rate would be. You know, clearly people talk about a flat rate tax system, and a lot of economists would be attracted by that. But you know, the complications of the tax system isn't the rate structure. The complications is what is defined as income. That's most of the tax code is what we call a taxable income event. And then there's like a page or two on the rates.
Sounds good. Let's turn back to Jim Pierce in D.C. Jim, do you have a view of the political scene from your perspective, either a plan that a presidential candidate has proposed that seems absolutely crazy, or one that seems, hey, that's pretty good?
Well, you know, politically I'm kind of neutral, but I do like certain elements of Jeb Bush's plan in that if people are serious about balancing the budget, there's got to be some sort of sacrifice involved. I mean, we all know we can't have our cake and eat it too. So, so long as everyone realizes that there's going to be some pain involved, I do think we're looking at some combination of tax simplification as well as cutting back on some of the deductions or exemptions. I don't think the home interest mortgage deduction will ever fly. But other than that, I think a lot of other things could be taken off the table. And personally, I would love to see some form of tax simplification. I'm also a certified financial planner, and quite frankly, I have difficulty filing my own taxes, and I should be the type of person who has no trouble whatsoever. But it just has become unwieldy. And more importantly, I think it does, at least on the corporate side, I do think they need to do something to lessen the tax burden on the corporations and encourage them to invest more in people and equipment.
Yahuro, are we becoming a nation that actually says okay to high taxes as long as we get a good amount of services in return?
Not necessarily. I think that's a lot of the backlash against Obamacare. A lot of the backlash are concerned about Bernie Sanders' program. I think there are people who are genuinely concerned that you erode some of the fundamental mechanisms of democracy when you give in to that, because the assumption is that government becomes big brother.
And government seems to spend less efficiently than a business. I mean, if I was going to hire a private contract to pave a road, it would cost X number of dollars. If the government did it, it would never get done and cost Y number of dollars. Right?
Really depends on who you ask, but yeah, for the most part, that's the perception.
Okay.
Yeah.
All right. Jim, as we go into 2016, do you have some advice for the folks at home?
Again, I hate to keep repeating it, but have a plan. If you have a plan, it helps you weather these sort of ups and downs. I mean, the market was down 3.6%, the S&P 500 the week before last. This past week, it was up 3.3%, which was the best week in a couple of years. So there's going to be volatility. There's going to be ups and downs, and if you sort of have a plan, then you have an ability to ride that out. If I could jump in just for a half a second, not that I'm like Jim as well, I'm sort of neutral politically. I think the problem with all of this stuff is there's nobody willing to compromise. Everybody's staking out the positions on either polarized side, and the only way we're going to solve all of our problems collectively is for everybody to meet in the middle.
Well, the 24-hour news cycle destroys anybody who says anything controversial whatsoever. That is the sad side of our media democracy that we live in.
And I think the
right
ugliest word, and they've stricken it from their vocabulary, is compromise. I mean,
well, if you're a compromise, you're weak.
Right, exactly.
Right, exactly. And they don't build monuments to those who are in the middle, right? Okay, that's all the time we have on this topic. Yahuro, Jim, Charles and Jim Pierce in DC, thanks very much for your time. When we come back, it is time for the lightning round, when we will look at the interesting stories from the week in lightning fast fashion.